Welcome to the Note Investor Podcast. We'll guide you through the ups and downs of note investing and teach you all about the nitty-gritty details of the business that other people won't talk about. Your host, Dan Deppen, is a former aerospace engineer and product manager who transitioned away from cubicle life to full-time note investing in 2018. Our website is www.fusionnotes.com, where you can subscribe to this podcast, comment, and find links to other information on note investing.
Hey everyone, this is Dan Deppen, and today I got a great episode where we talk to Kyle Zimpleman. Kyle's a really experienced real estate investor going back to the 90s and has done a ton of notes and has lived through a lot of the different cycles. So we had a really good discussion about this kind of unique state of the market that we find ourselves in and some of the challenges that folks are running into. But before we get to that, I wanted to let you know about some things going on at the end of the year. So, as you may know, oftentimes as we get into the fourth quarter, you'll have some note sellers that have certain assets they just want to get off their books and get rid of. I know for myself, there have been a few years where I've picked up some really killer deals right at the very, very end of the year. That's not always the case, but sometimes it is. This year is kind of weird, so we'll see how it goes. But if the deals do show up at the end of the year, you want to make sure you're prepared. So one of the things I wanted to do is help everyone get ready for that. So what I'm doing is offering a bonus with the systematic due diligence course. And I just sent out the details of my newsletter a couple days ago. But now if you get the systematic due diligence course, there's some additional materials that I'm adding in. And then you can also do a 1-hour coaching call with me that's included. Price stays the same. So if you're interested in that, you can check out systematicduediligence.com or the Fusion Notes website. Let me know if you have any questions about that. But now let's get on to the main show. Hi, everyone. Welcome to the Note Investor Podcast. I'm your host, Dan Deppen, and today joined by Kyle Zimpleman of Expand Capital Group. So, Kyle, how's it going?
Hey, I'm doing pretty good. How are you doing?
Not too bad. Well, thanks so much for coming on. So you've got a pretty in-depth background in real estate investing. So maybe start by giving us just like kind of a quick overview of some of the things you've done.
Yeah, there's a laundry list. We could start out all sorts of stuff that I've been involved with. But I got into real estate in 1999 as a realtor. I came out of college. My dad was a broker. Hey, you can make all this money in real estate by helping someone help buy and sell houses. And then I gradually went to in Grand Rapids. I was Grand Valley student. In downtown, there was all this need for housing down there. So they had these, real expensive places and then these dumps. There wasn't these five. So I started buying these 5-6 bedroom houses, and I created what's called Fulton Management. And we built, we didn't build, but we would take a 5-bedroom place. At that time, it was like $80,000, put college kids in them. So if I thought I would live there, I'm like, okay, I'll try to find a way to buy it. And that was when, anybody with a pulse could get loans and all that fun stuff. But, I did all the Burr method, everything you people talk about now. And then all these, young kids that are like, well, I got started in 2010 and I just kept on going up and up, and I just make more and more money. Well, yeah, at some point you're going to end up in a correction situation. And so that's what happened to me was as I built this portfolio of 40, 50 houses downtown, became, over leveraged in a lot of aspects. I was just talking to another guy. I said, before I was stupid and aggressive, and in ways it paid off for me, in ways it didn't. Now I'm like smart, but scared, and I don't do anything. So it's like, now I know better, but then it's even more frustrating when you watch somebody overpay for a multifamily or, I got 2 guys together. We bought this for, $500,000 and we just sold it for $1.6 million. How awesome are we? What'd you do? Nothing. Hey, rates went down. We're awesome. No, it has nothing to do. It's not like they had some sort of like innate skill. It's just that when rates go down, down, and down, your purchasing power goes up, cap rates get compressed, and everything goes the other direction until it doesn't, And so in 2010, I started Expand Capital, first Expand Capital, as a way to buy distressed properties, because I was seeing all these houses that, I was buying for 100, 150 grand, going for like 30, 40 grand. We picked up this one 4-unit property on Douglas Street. So if there's any Grand Rapids people don't know what I'm talking about there. And I picked it up for $26,000. And every unit was fine, but the last unit, the top far unit had an ice single, whatever you want to call it.
Ice chandelier.
The size of I can wrap my arm around it going all the way down, but it was frozen solid. So I thought, well, worst case, we'll have 3 units. We'll figure this out. But we ended up just keeping it frozen, chiseled all the ice out. And, that was part of my career of, moving it through the Great Depression into rebuilding, buying, those type of properties. And then I realized at some point, well, they're not giving us money like they were giving us money before. Hard money lenders I was at 12%, 2 points. If it went past 6 months, you pay an additional month. If it goes past a year, you pay another 2 months. I held some of those properties because I bought those in 2008. I sold those in 2012. 4 years I held that note.
Oh, wow.
On 2 or 3 of them. So long story short, yeah, that was my background. And then, so I'm going to get to the note part here pretty quickly, is what happened was in about 2012, I couldn't get financing, so I needed to bring in other people to help me out with the business. And so I brought in my doctor buddy, his dad, some other people, and we started financing more deals. And then in 2017, 18, I'm like, oh my God, the prices have gone up so much. There's no way things can be sustained. How is a renter going to pay this? Well, let's get out. So we sold everything. Now we're sitting on money that I've never had a decent chunk of money sitting there. I'm going, what do I do with this? I can't put it in my savings account and pet it all day long.
Mm-hmm.
I can't go buy that same property that is sold. And so I started listening to these, podcasts and, Scott Carson and some Eddie Speed stuff. And I go, okay, I'll take a little bit of this, a little bit of that, and try to put it with my knowledge. And at that time, Harbor was selling off a lot of their stuff, 2017. Mm-hmm. And I started getting these tapes, and I'm like, holy cow. I mean, because I've never seen the value differences before, like, okay, this is only $30,000 note, and the property I know is worth 90 or 80, even if it was in rough shape, and I'm going to make 10%. Let's go all in and create a company, create a fund, because there's no way I could just do this on my own. And so I go all in. It takes me, 5-6 months to get this fund together. By that point, it's been cherry picked over and over, and all the stuff that was decent was not so decent anymore. And so I'm like, oh, okay, I still was able to, buy up a decent chunk for myself before I started the group. And so I put those into the group's deal. And basically from that point on, it's been, how do I maintain a yield high enough that I can get other people involved? Because people are like, well, you're at 12, 14%, I'm like, well, that's gross, number one. Number two, people don't always pay on time. Number three, you have to take a property back. It's 3, 4, 6 months. Then you got to figure out what you're going to do with it. And then there's that lost time frame. And then somehow investors are going to want to make more than just a preferred return at the end of this thing. They're going to want some sort of, magical equity.
Yeah, some kind of upside.
Work? There is no magical equity unless you can figure out this partial, plan. Mm-hmm. And so maybe some of this is over people's head a little bit on this part of the business. I'm not sure who a lot of people that listen to this, but long story short is it has gotten so difficult to find anything that makes sense in this business. And people can see that if they go on, realtor.com or Zillow, they can see all right, these values, how the heck is someone paying $800 in rent, but you want 150 for that place? Doesn't work. It's not even a cap rate. That's a zero cap rate, and being in the business and knowing what a tenant's going to do to a property, knowing that at some point the roof is going to go bad, the furnace is going to be replaced. I had college kids leave in December and they just clicked off the heat one time because they didn't want to pay the heat bill. I go by and I find my house is frozen solid, and that stuff is the stuff that happens in this business. I'm like, okay, let's get away from the toilets and termites and the tenants, and there's going to be this easy business called note investing. And then you flip that switch, and now you're really dealing with a lot of legalities, a lot of lawyers. As soon as that property goes defunct or goes bad, if it's a full mortgage, you're just paying lawyers left and right, big bucks.
One guy, taxes and insurance usually too, while all of that's going on.
And then you're paying the insurance bill, and then you're trying to I can't fix this property because I don't own it. I have to sit there and watch it deteriorate. So it hasn't been that magical investment. However, I still believe in the fact that it is probably the best investment out there right now for people to buy, because the whole thing you're trying to do now is protect yourself with equity. And if the market corrects or rents don't just keep on going up and up, and if rates can't go any lower, which they can't, how we're going to see appreciation, and why is you buying at a 5% cap rate or yield return, how are you going to make that sustainable? You're not in the rental side of it. Mm-hmm. Now, on the mortgage side of it, you can buy something, that's worth a lot less, but the borrower knows this too, okay? Everyone's like, we'll just get the property back and we'll just have them sign over a deed in lieu. No, if they know there's value in the property, you're going to, one, you'll probably never hear from them. They'll just, you can actually make contact. But so long story short, the business is a lot harder than I first imagined it to be. You really are almost being, when I created the first investment group, I thought, okay, this is a fund, we're buying property, it's going to go up in value. In this way, we're really a fund in almost like a yield perspective. Like, can we do better than S&P? Can we get to a 12%? Can we safely protect people's money? The answer is yes. That's the answer. However, how much time it takes me to do this is it worth my time? That's where I miscalculated, because I thought, okay, if I could just get to $1 million or $2 million in investors' money, now I'll just be able to buy this and buy that, and I'll be awesome. Mm-hmm. It's not a lot of money, number one, as much as I thought it was. You're buying for cash, so there's no leverage, real potential that you can do a partial and those type of things. Number two, there's no real, if it's performing, your only exit strategy is to sell it to another investor, really, if it's performing.
Right.
And they're going to look at the same metrics you are. So it is, and there's not a lot out there, because if you're earning 0.0% in your savings account, you'll take a 5%. I see that some of the big guy stuff that comes through, they call it scratch and dent, Fannie and Freddie.
Right. Yeah, those are tiny yields usually.
And okay, the rate, the WAC they call it, the overall pool is like 3.99%, and you're going to get a 5% discount to own that paper, and it's now not federally insured either. So you're just getting 4% on property that was just purchased that's overvalued. So something's going to hit here in a large sense, because right now they're able to unload all this stuff on the secondary markets. There's an appetite for all that. But once things start to go the opposite direction, which every spiral goes the other way too, and in my opinion, it wasn't like 2007, all of a sudden everything went down to nothing in value and we all were sitting destitute. It was similar to what happened in March, April of this year, where it's like, oh, that was kind of a weird bump. And, oh, Lehman went under. Well, I didn't even know who there was a Lehman. Who was a Lehman?
Yeah, these things take time. I've gone back and looked at those timelines in like '08 and then even in the dot-com crash in stocks before. Yeah, and it wasn't like one day they flipped a switch. It happened over time. And I think right now with the stock market being crazy and interest rates being low and bond prices being high, a lot of times, yeah, those scratch and dent mortgages at 4 or 5% for some institutional investors make a lot of sense. It's like it could be the best thing going, but that doesn't leave you enough as an individual who's going to bring on investors to pay them what they need and then have it.
And then how do you make money in that deal too? And then there's the underlying thing that you really are doing when you're syndicating a deal, and it's your friends or it's your business partners or people you work with. You're guaranteeing this deal, okay? So all your money that you're invested is the money that's cushioned, that if something happens, you're going to lose all your money, and then they're going to get their money back, and then some, hopefully, whatever else. So you not only are you risking your time, you're not going to that 9 to 5, you're stressing yourself out, you're trying to figure out all these business plans and game plans of how to make this really work. On top of that, you're really guaranteeing everything you're doing to some extent, in which you don't really have that control. Like, things can happen in any business, So that adds another element of stress to what you're doing. And then unless you have a 10 million, 50, $100 million fund, you really can't move money around enough to make a good living doing it either. For the risk, for the reward, for the stress, you need, $10 million to make it worth somebody's time to leave corporate America, where you got the cushy 9 to 5 and you can hide behind somebody else's emails and other things too. You can't do that in this business. It's okay, Kyle, you said we're going to get an 8% preferred return. Where's our 8% preferred return? Well, here it is. It's 8.25%. So I made 2.25% that year, running around, doing everything we have to do in this business. So long story short,
you definitely can't make any guarantee. I mean, there are no guarantees that exist in the business. I had an exchange with somebody a little while ago, and he basically asked for a guarantee. To me, that's like the G word. I'm like, we're done at that point, because
you can't use that. You can't say that, but I'm saying implicitly.
Yeah, I mean, you do what you can to. If something goes wrong, to take care of it. I'm going to lose all my
money before I lose somebody else's money. I mean, that's the bottom line. Right. Because reputation. I'm not moving. I can't just move, and I have family and kids, and you can't just up and take off if you're a scam artist or something. You've got to stand by your word and what you do. And so I've been waiting pretty much since 2008 going, okay, well, maybe today is the day the sky falls. Maybe tomorrow is, maybe whatever else. And then that whole COVID thing hit. There's always that black swan event that creates something, a catalyst, the mortgage the dot-com bust. There was probably a few companies that created the avalanche. Same with '08, it was before AIG, it was Lehman, it was somebody else. It was all these other companies that brought it all together to create this huge problem. Now with COVID, and we're talking at March, April, I was like, okay, here it is. This is the stuff I've been emailing people about and telling them that, hey, a recession is obviously a cyclical thing. It has to happen. Otherwise, bread would be worth $18 right now. Now it's worth $3 now. That's too much. It's all going up. But then we have this V-shaped recovery. It goes crazy the other direction. They throw trillions of dollars at everything. And then what you were saying too is, things take time to unwind, to unravel, to I was just listening to something that Sam Zell, which is a super rich dude that, is one of the best multifamily operators in the world. I read all his books. Anyways, he's saying like there's just not a lot of deals happening at this point because there's too much separation between the seller thinking, hey, I want this price, and the buyer going, do you not see the risk that I'm seeing? There's no way I'm paying you that price.
That's what I've been seeing in notes as well. I mean, I haven't really seen, it seems like the trading volume has been kind of thin. I mean, I've picked up a couple things here and there over the last 2 months, and mostly it's just been from other note investors who have an investor that wants to cash out.
Yeah,
what they have, but it's not your normal. It's not like the heyday of when Harbor was selling off all their stuff and there was good stuff that you could.
Yeah, you could buy that at 60 and then sell it to somebody at 70 and they're safe. And now they're selling their stuff at 70, at 80. And now I'm seeing that selling at 90 cents because it's like, well, it's 10%. And here's the history. And if you're in a state that allows forfeiture, in a way, they have a good story that, hey, there's a chance you're going to own property worth a lot more if it goes the other direction, even at 90 cents, Now, I wouldn't be buying mortgages at that because not in Ohio or in some of these other states where you just sit on property for years and you watch the lawyer bills just stack up and stack up. Yeah. And then you're afraid to send the guy an email because he's going to charge you $45 for that email, some of these groups. And once you got started with somebody, once you get a certain degree of into a foreclosure with an attorney or something, you really you're on that horse till they get done,
Right.
You're going to be charged, you're going to be charged. So I went a little tirade there because I've been, cooped up in the house here too. We're kind of, wife is a teacher, so she's out going to school, but she doesn't have any kids.
Oh, are you guys in school? Okay, because my kids are
right over here, and so until they go back in 2 weeks, I'm basically under house arrest. So I just so it's interesting times, and I think there has to be some give and take on this mortgage side of it. You can't give forbearance and forfeiture or foreclosure and relief and eviction relief and throw all this money around. There must be, in a capitalist society, a risk-reward system. And at some point, we're going to, day of reckoning or how you want to call it, we're going to see that. And we've been on the longest expansion in history of the United States. It's never gone 10, 12 years before without a catalyst problem. So as an investor and a guy who went through the Great Depression, or we want to call it recession.
Great, yeah.
I lost my hair. I'm not that old. Yeah, Great Recession, not Great Depression. You're constantly in the back of your mind is like, okay, if I do this, what's my downside, and is this the right move, or should I be waiting on the money because I think something better is going to happen? Why would I take this 10% return right now when I think I could just get a quadruple, home run if I just sat and waited on the money? Well, then you sit in the money, it doesn't go anywhere, and there's no these opportunities that are out there. So it is a very frustrating time for someone that has the experience, but there's no deal flow. And
my approach lately has just been to be selective. So I've just been able to grab some onesies, twosies here and there. And so just try to be real, careful about what I do pick up and be pretty selective, just kind of grab what I can. And then just sort of waiting for, the tide to turn. Because there should be, I don't think we're going to have a wave of non-performing residential loans like you did 10 or 8 years ago or whatever. But I think at some point the number will increase when the dust settles from all this stuff, but I don't know how long it's going to take. It's not, necessarily going to be like next month. It could be, could take a little bit.
The trough or whatever you're going to say didn't hit real estate till about 2010, because even if you start foreclosure right now in some of these states, they're so backed up as it is. it's going to be 2 years before that property even hits the market, or a year. And so I've been trying to tell people is everyone's sitting there waiting for on the MLS for these deals to pop up again. I go, I don't think it's going to happen that way again. I think it's going to happen behind the scenes. The banks are going to sell this stuff off. They're not going to just put their names out there again. And here's this foreclosure brought to you by Bank of America. You know, no, they're not going to do that right now. They want to get rid of it. And so they're just going to move that paper underneath and sell it to bigger hedge funds, you know, bigger groups. And we're hoping that it will trickle down to us after it gets cherry picked a million different ways.
Right.
And so that's the other part of it is, even if it does come, are we going to see it? You know?
Yeah. I mean, I take time. I think thinking back to the last cycle, I mean, I think Florida was one of the leading states. And I think it was maybe like 2006 where their property values started really getting slammed. And then, like you said, some of the full effects didn't start getting seen until 2010. And I think I wasn't active at that time in notes, but I believe, you know, notes didn't start popping up for individual note investors until even after that. So it can take a little bit of time.
Yeah, I mean, if you go to the IMNs and some of these other, you hear some people talk, oh, I want to go back to the days we could buy it at 10 cents and 20 cents. And I'm like, I don't think that's ever, well, what occurred is never going to happen exactly like it occurs again. It just never does that. But another tool in our tool belt is we now know that this stuff is out there, that we can find it along with other stuff. The other thing I think that is really overvalued and possibly very huge bubble would be multifamily. Like, I used to sell the stuff and, you know, be 30, 40 grand a unit. Now they're like 80, 90, 120 for some areas per unit. Mm-hmm. You know, and the math doesn't make sense, you know, and it's flying off the shelf.
Yeah, I don't really know anything about multifamily, but it just seemed like when I would go to local real estate meetups here around Colorado or other places, this was back before COVID when you could do that. It just seemed like everybody and their mom was interested in multifamily. That was the big thing that everybody wanted to do. And so, yeah, I just had, like I said, not knowing anything about it, but just had the sense, well, if that's the thing that absolutely everyone wants to do, those deals have to be getting thin at some point.
Well, yeah, those are thin. That's an industry you can get really hurt on if you're not experienced in it too. And the biggest issue is like, okay, we syndicate this deal and we buy this multifamily, and our investors are expecting this, you know, return after everything is all done. And then they're expecting when you refinance it that they'll get cashed out and triple their money. There's a lot of things that have to happen in between that for that to occur. And yes, you can get lucky from 2010 to 2020. But how are you going to get lucky from 2020 to 2025 or whatever, when you can't lower rates, when banks are going to start tightening things up? They have to at some point. When renters aren't paying, when renters can't pay, you know, a third of their income or 2/3 of their income to just live in a shack somewhere or whatever, or 600 square foot place. But then I go back to like, okay, am I just the old guy saying, get off my lawn to kids now? Cause I've been through, 2008. I need it? Like I said, am I stupid? I don't know, so.
Well, I mean, I think you just want to kind of balance, take advantage of your experience and don't get, like I've talked to some people, it seems like they were kind of anchored on some of those old prices, of getting stuff, whatever it was, 10 cents on the dollar and all that. And just, try not to get too gun shy from things that have gone sideways. I know I've certainly hit, my share of hiccups and, had my lessons learned and what I just got to kind of incorporate those and keep going.
Yeah. I mean, at this point in my life, 43, I guess I am now. I'm like, okay, it's time now not to keep on, hey, is that stove hot? Ah, it is. Oh, I should already know it at this point to avoid, certain things in certain markets or certain, business ventures and whatnot. And so that's my goal is with why I created my investment group was there's got to be a lot of other people like that too that are going, okay, we either sold out of an investment or we made all our money back out of the stock market. Do we want to leave it there? Where can we put money that is going to be safely, as much as you can say safely put? And I can't find anywhere to put it other than notes.
Yeah, that's the thing, right? It's not as good as it used to be. It has its challenges, which kind of was what makes it a good market, because that's what keeps everybody and their mom from trying to do it. And relative to a lot of other things, on a relative basis, it's almost as good as ever. I mean, and I'm curious too, like what you've been seeing as far as your performing loans. How have your borrowers kept up during COVID and everything that's been going on?
Surprisingly, I think we only have one person and they called about the COVID relief thing. I mean, through our service company, I use Allied, and the rest were making payments. In this business, sometimes people go back a month or two and then they catch up for a month. I mean, it's you're dealing with balances of 30, 40 grand, which are in my opinion, very, very low. You're talking less than a car payment, $300-$400 payments, but there's a lot of people that still struggle to make that payment, and then the question then becomes, what else are they not making payments on or not fixing up, or they're not going to have money for the roof if it needs to be fixed. So you gotta balance that with your risk return, and but I can't find a better place to put money right now. That's the thing.
Yeah, I've seen a similar thing, and I've been pleasantly kind of amazed at how well all my borrowers have hung in there.
Mm-hmm.
I mean, because I have borrowers go south all the time, even when things are good. When this started to hit, I assumed that, a lot of my loans that were paying were going to stop, but then maybe pricing on notes would go down. And it's been kind of the opposite. Everybody's hung in there. I've even had a couple borrowers recently make big reinstatements. I mean, borrowers that you couldn't get them to make a $300 payment if their life depended on it, and all of a sudden they cough up a few thousand to prevent.
Part of
that happened more than once during COVID, which is
here's why I think, and I talked to some pretty big apartment guys too that eventually I'll start getting back into that, but they didn't skip a beat either. Nobody skipped a beat because the government gave them $600 or $1,000 a month, or not a month, it'd be more than that, $2,400 or $3,000. So that's where they got these lump sum money from. Came from not from the sky, the helicopter money.
Yeah.
And now that's ended, and I think that's why I think once this Band-Aid gets ripped off and they're already fighting on new stimulus, how many trillions, the T, can we throw at people before we really have a problem? And then it dawned on me, because I always looked at our national debt and other debts, and I was like, wow, how crazy this number is. And it just keeps on going. Our government will never pay it off. They'll never pay it down. It's not real money, Kyle. They printed it, they created it, and then they bought it back, created a bond, and it's poof. This is not real money. None of this is, and I think I came to that conclusion, and that's also kind of like disheartening, because it's almost like you're going to reward people for bad behavior. You're going to reward people for not paying their rent. You're going to reward them for not paying their house payment. Just stay. Because, there's a chance if you got kicked out, you might cough on somebody.
Right.
It's like, so I mean, that's my 2 cents on it. But I know there's a real pandemic. My wife will tell you that left and right that, there's issues, and I get that. But there's risk for me walking across the street, but I still take it. You got to live at some point. So that's my other 2 cents. I know we're supposed to keep this thing at like 30 to 20 minutes. So
well, no, actually we go as long as we need to. That's just sort of the guideline. But But yeah, definitely crazy times. And I definitely continue to predict wrong, like what's going to happen over the next 4 months. So it gets more confusing as it goes along.
And then I guess then the financial planners are right. They're like, you just leave it in there and you just always pump it in and eventually it'll pump out more money. How? It just does. That's what it's been doing forever, Okay.
Yeah. Well, I mean, you're
So
talking
it's
about
like,
black swans, and I mean, it's been an interesting like 20 years where you had the dot-com crash, 9/11, the financial crisis, now COVID. I mean, I think it's really rare historically to have a number of events like that in relatively a short time span. It's been really nutty.
I talked to my wife's parents because we were seeing these headlines and how the market went up and down and all this craziness. And I was like, have you ever experienced, I mean, am I just too young? Is this normal? He's like, no, it's not normal. No, just keeps on throwing trillions of dollars around. This isn't normal. Nothing about this is normal. We're paying people not to work. We're paying people to, none of this makes normal sense other than the guise of a pandemic, which I understand, but is the cure worse than the problem?
Yeah, I don't know. It's weird, because I always wonder, like this last 20 years, is this a blip or is that just going to be normal and is it going to amp up? Because you kind of had this long period of time before that between like World War II and the end of the 90s where economically things were relatively smooth for the most part. Like I know there were oil shocks. There was a lot of stuff that happened in between, but overall, I don't know that there were any massive like black swans. But of course, if you go prior to that, right, you had the Great Depression, you had World War II. Those are pretty massive events, back to back. Probably bigger than anything we've seen.
Yeah,
So who knows? Hopefully, maybe we'll be in for another 50-year run of smoother waters, or maybe it'll just continue to get crazy. I don't know.
I was telling my wife, I said, well, my grandma, when she passed away, we would find these old cans in the can cellar, dated back from whatever, which was canning goods. I said, that was because after the Depression, it was she thought you need to save stuff, And then I opened our drawer, or our thing, and we had nothing but toilet paper on a whole shelf, just covering everywhere. I'm like, well, this is our thing. We have lots of toilet paper now.
So you were one of the hoarders from a few months ago?
I wasn't, but I guess wife said, let's just get us all from Costco. We can. Like, fine, give me my toilet paper. I don't know. But we have a lot of it now. So we're good there if this happens again. So
that's good there. And what's funny is because that happened last time, the next time something wacky happens, it's going to go even faster.
Yeah. And then we do have just in time everything now. So, I mean, like I order some from Amazon, it's going to show up pretty quick. So, I don't know. It's, all you have to do is, and I think, education and fundamentals of business and investing are going to pay off in the long run. Warren Buffett, all these other guys have all those liners you've ever heard, when others are fearful, be greedy. When others are greedy, be fearful, all those things. And right now everybody's greedy and I'm fearful, but I've been fearful for like 2 years. So how much fear do I need to have before I can, go the opposite direction? And when we're doing this investments, we're doing all cash. So it's like, if you put $500,000 into buying a bunch of notes, and you could have bought a $3 million apartment building, same down payment.
Right, you could have leveraged, yeah.
You leveraged it, and if in 2010 you would have made so much money. I mean, we made a lot of money on our college housing, more than I ever expected to. I had read books by Harry Dent and all these other dystopian guys that are like, what, this is just the start of the new world order and you need gold and guns and that's how you're going to need to live. And 2010, whatever else. And the total opposite happens, like it would just go on this tear. So who knows? I don't know.
Yeah, it's always hard to predict. I'm not going to build any bomb shelters or anything though.
Not this time, and I mean, I don't know. So I guess to wrap it up is, of all the things I still believe in, I don't believe the stock market. I've never really done well because I think I look at it too much. In real estate, I really do believe in fundamental of buying rental properties and holding long term. The tax benefits and the depreciation, all that makes a ton of sense. The problem right now is you're going to compete against idiots and you're going to overpay. And I'd rather just wait. And so, and then if there's anything that's going to make sense right now is buying something that has a $30,000 balance that you bought for 20 or whatever it is. And if that person stops paying, you're going to go through a very quick process here in Michigan, 3 months, 5 months, you're going to have that house that's worth $100,000. Where else are you going to find that? I mean,
the challenge is going to be if the tide turns and you start seeing more notes available and they go on sale and there's real economic problems and those opportunities really show up, maybe not to the degree they were 10 years ago, but close. All your investors are going to be at their maximum fear. So that'll be the next challenge is when the opportunities show up. That's where investors will have their peak fear. So that'll be
right. They're going to be like, well, I just lost half my money in the stock market and I can't get out of this real estate deal that you told me not to get into in the first place. I know, and they're going to be stuck. Yeah. And that's exactly what happened the last time around. So I do a lot of writing on a monthly basis. I send out, newsletters and stuff about, why this business makes sense and that I do believe in markets have cycles and we have to be at the top of one. Mm-hmm. And my thought is, hey, if I can at least show them this piece of paper I wrote from 5 years ago, when it finally does hit, that they'll go, oh, Kyle, here's all our money. I don't know.
Well, I'll put links to your stuff in the show notes, but how can people get a hold of you if they want to reach out or get on your newsletter?
Yeah, they can shoot me. So I'm working on another website, but the website right now is just expandcap.com. And there's information on there. But I'm looking to move a lot of my articles and all our photos of properties and videos if we have them on property. I'm going to create another website for that, hey, here's the proof and here's the pudding. This is the real deal. Here's exact property. Look it up. Look on the deed. We're on the deed, blah, blah, blah. Or we're on the mortgage. So we did this. This is what we bought it for. This is why we did it. And this is why it makes sense. And so that's all I can do right now is show people, hey, this makes sense when you can find it. So
no, sounds good. That's probably a good stopping point. So Kyle, thanks again so much for coming on.
Yeah, no problem.
I'll have to do it again sometime next time. Like I said, I'll put links to everything in the show notes. Until then, I'll see you guys next time.